Canada added more jobs than expected in November, and wage growth held firm for a fifth straight month. But there was a slightly higher unemployment rate. It hit 5.8%, the highest since the start of 2022. And hours worked dropped by the most since April of 2022. Let's tie it all together with Derek Holt, Vice President and Head of Capital Markets Economics at Scotiabank. Derek, always great to see you. Just summarize these job pictures, though. Do they point to a labour market that is weakening?
No, not at all. It's I think on balance, this is a good set of numbers. It should give Canadians confidence. I mean, this economy has created 430,000 jobs on a year-to-date basis.
Wow.
That's astounding. The year's not even over yet, and another 25,000 in the latest month. I like the details on balance. They weren't perfect, but they were mostly payroll jobs. They were all full-time jobs. We saw wages accelerate again, 7% month over month on a seasonally adjusted annualized basis. That's the kind of wage growth that we're booking still. On a 3-month and 6-month moving average basis, we're getting, by that same measure, between 6 and 7% monthly annualized wage gains. And so at the margin, Canadians are getting paid more at the same time that we continue to create jobs. And that's a good support for the consumer going into the holiday shopping season.
What about wage gains? Because you have been warning that these big wage increases are going to lift inflation for years yet.
I think that's a definite risk. I'm not at all convinced that inflation risk has subsided. I think on both a cyclical and a structural basis, inflation risk is still pointed higher in Canada, and it's too early for the Bank of Canada to let up its guard. And wages are a part of that picture. Listen, the most recent 8 major settlements in Canada in the collective bargaining process have had an average term of about 3 years. The first year is settling in upon 6% wage gains. The second year is, and outer years are settling in upon about 4% average wage gains over the contract's period of time. That's well above the Bank of Canada's 2% inflation target. And I want to be clear, I'm not blaming the people who are seeking those wage gains. I'd probably do the same if it were me. I'd strike while the iron's hot. But at the margin, it's tough to get inflation down with people getting paychecks rising that rapidly.
You're not wagging your finger at people and telling them to tighten your belt, like I think a couple of central bankers have done. In any case, Derek, sorry about that. You have an axe to grind here, or rather something you want to point out to people. We hear a lot of complaints, oh, well, per capita GDP is not going up because we've got so much immigration. But you think there's a devil in the details here?
I think there is. And so for one thing, I would make an adjustment for the fact that so much of the immigration has been in the temporary resident category, a lot of international students. If we take that category out, the per capita real GDP figures aren't as bad by any stretch. They're higher and they're not shrinking anywhere near as much. And I think that's an important adjustment. I think back to when I was a student. I wasn't a big driver of economic activity. Students were paying their tuition, they're paying for their books, their residence, their meal plans, maybe a bit of beer money left over, but they're not big drivers of economic activity. And so if we're taking on so many of these international students as a key driver of the immigration wave, we probably should adjust for that. And the second thing is, as they go through the process of basically building their human capital, their knowledge base, they're going to be big productivity drivers in future when they enter the job force. And so the third argument here is that there's kind of an analog to Alberta's oil sands. When in years past, so much capital was going in, it was a big capital and productivity sinkhole, and there wasn't much productivity going on because they were investing much until the projects turned toward output. Well, in terms of immigration, there could be an analog here in the sense that the first round effect depresses per capita numbers. The second round effect incorporates and assimilates the new arrivals into the economy. They get their jobs, they join the labor and housing and consumption markets, and they ride a bit of a productivity improvement in the aftermath. And so this is a multi-stage process. I think some of the people pointing to this are too bearish.
You say there is actually misinformation out there about the economy. For one thing, people saying or implying we're in a recession, but you say we're far from that?
Yeah, far might be a little bit of an exaggeration, but we're not there. Yes, I think I'm comfortable with that. I mean, the second quarter was revised up. We were north of 1% quarter-over-quarter annualized GDP growth. Final domestic demand that takes out some of the more volatile inventory and trade components, that was also north of 1%. The third quarter, we contracted on GDP, but we continued to grow on that final domestic demand picture, and we're tracking positive growth into the fourth quarter. So even the technical definition of recession, back-to-back quarterly contractions in GDP, is not being met, and the job market is incredibly strong, and so a less conventional definition of recession is not being met either.
So is there evidence that employers are still having trouble filling positions? Because as far as I know, that is a classic portent of an overheated economy that's about to start sliding.
You're right, Andy. Yeah. And there's a little bit of that evidence that's ongoing, but it's not as powerful as it was. The job vacancies are pulling off the peak, but they're still higher than pre-pandemic. Job postings are diminishing at the margin, and so that's a sign that the labor market is cooling at the margin. Mm-hmm. But we could well have a picture in which job growth cools, but we've cemented years of aggressive wage gains going forward.
Leave us with a final thought. Maybe we can put up the Canadian dollar over the past year. Now, we know, of course, the US dollar has been coming down as the prospect of many more interest rate increases retreats. But the Canadian dollar really, it has rallied off its lows, but it's still stuck below 75 cents. Is that good or bad for our economy? I know it's good for our exporters.
The quick answer is yes, it's both. It can be a plus to exporters, you're right. It's a negative for all the goods and services, goods principally that we import, because we import a lot of what we consume. It's a negative in terms of the cost of capital goods, because we import so many of our capital goods, machinery and equipment from principally the United States. It continues to present pass-through risk in terms of inflation as part of my inflation narrative at the margin. And I think there's a case for how the Bank of Canada looks at the undervalued level of the Canadian dollar, coupled with the dramatic rally we've seen in the bond market and renewed mortgage rate cuts, and comes across sounding hawkish next week. And I don't think the market's prepared for that.
Hang on, give us that last thing again about mortgages, Derek. I missed it.
Sure. Okay. So the key ingredient to pricing the 5-year mortgage rate is the Government of Canada 5-year bond yield. And it topped out at about 4.4% in early October. It's back down almost a full percentage point lower now. It's getting back down to last spring's housing market levels. And so if the Bank of Canada is not careful next week, it'll light up the housing market all over again. I think they need to lean in the opposite direction. Oh,
it'll inflate the housing market yet again. You mean that's the risk?
I think so. We still have low inventories. We still have surging immigration. We have first-time home buyers who are sitting on the sidelines amassing bigger down payments. We have strong wages and strong job growth. I don't think they want to add rate cut fuel onto this fire. In fact, I think they probably will come off sounding in the opposite direction next week.
Okay, a bit Scrooge-ish. Oh no, a gratuitous Christmas reference, far too early.
Andy, I'm often asked, are you bearish or bullish? I've been on the most positive on the economy, but I'm just cautioning that I think in terms of rates and inflation, let's not give it up too soon and get too crazy here.
Oh, okay.